shift our focus even to the equity markets, where we have seen quite a bit of a rally. What should your mutual fund strategy be? Rajesh, let's talk now about the other big factor, and that is the massive rally that we have witnessed in Indian equity markets. The Nifty 50 is at these record high levels. How are you looking at this run up, firstly, in the equity markets?
Yeah, equity rallies in general, we have to see it as an optimism. It is an optimism or investor confidence based on that in growth environment within the macroeconomic outlook or earnings outlook or business outlook. So if there is an during optimistic times, you tend to see markets rallying high. And as actually this optimism eases a bit or pessimism takes place, I think you tend to see falling markets. It has to be seen from that perspective. Rather, one should not get actually bogged down or should not get burdened with the highs of market, whether it is market is all-time highs or all-time lows. I think all-time highs means at that time you need to give certain treatment to your portfolio, different particular treatment. When market is in a falling mode, that time you need to give a slightly a different treatment. What is the treatment actually that's where I think investment advice actually of a professional investment advice actually plays a role. Yeah. So these currently, as you rightly asked, I think how do we look at it? I think the current market highs macroeconomy for India as an economy. Second thing is earnings outlook for corporates is also looking quite healthy. Unusual to last 5-7 years. I think next 2 years and 3 years earnings outlook is looking quite healthy. Demand outlook is also quite healthy. So combination of these factors, and the liquidity is also supportive now across the globe, including in India. So combination of these factors, market is marching highs. Almost every day a new high market is marching.
Okay. Now you're pretty confident that things are looking good for India, and that essentially is trigger for the markets as well going forward. I would like to know that we've talked about those individuals who are already well invested, and good for them, they've made good money. But those people who have not yet invested, then Rajesh, they would be thinking that, okay, markets are already so high, and I've been reading about how valuations are very stretched, etc. So I'll be buying very expensive. How would you convince them otherwise? How would you since you believe that there is room for wealth creation for mutual fund investors even from here on?
Yeah, it is quite pertinent. We day in day out we keep hearing this question. So when actually markets at about 6 months back or a year back, people were quite wary of the pandemic, etc. They were wary to invest. Now I think markets are at new highs, making new highs. That this time they feel I think markets are quite expensive. Would really be investing, or they should be waiting? The answer to this is I think there is no good day or there is no bad day to start investing or giving allocation into the market. This is at the end of the day. I think one has to keep in mind how much. I think whatever allocation one is looking at it is not meant for 3 months, 6 months, 1 year. It is meant for 3 years plus kind of horizon. Investment horizon should be 3 years plus. So hence, if the market, despite market is about 16,300 or 16,350 level, market investors should keep their allocations intact and keep increasing their keep giving allocation pressure. But while when a market was at about 10,000 or 11,000 or 12,000 levels, I think possibly you might be putting money with more confidence. With I think some lump sum allocations can be done. When market is there at about a new all-time highs at about 16,300 or so, so you can't be wary and you should be stagger. I think possibly I think you might think I think market might give in some correction as valuations are quite expensive. So one could stagger, but staggering how much you could stagger, how far you could stagger. That answer is there is no right answer or wrong answer. What we are suggesting our investors is the 3 to 6 months one could stagger. So that I think STPs can be considered instead of I think lump sum allocation at this level. 3 to 6 months kind of staggering could be considered rather than I think completely staying away given the kind of levels of the market.
Well, yeah, that's why you have this wonderful product called SIP, which does the work of staggering the investments for you. Now let's talk about those already invested in Indian equity markets. Rajesh, how can investors, Or rather, firstly, you have a certain asset allocation plan in place. Now, how do you, the market has rallied, so it's possible that many people's equity part of the portfolio has ballooned in size versus the debt part, or for that matter, even the gold part, because gold has fallen. Even debt funds have not really done anything so far this year. So, how important is it to rebalance portfolios?
Yeah, this is quite pertinent and is quite an important aspect of the asset allocation. So as strategic asset allocation of X, I think if it goes to X plus 20 or X plus 25 with the market rising, so that needs to be rebalanced and brought back to that X% of the strategic asset allocation target levels. As I think when market is rising, the one market rise a particular level, then you think that the valuations are quite stretched or quite from these levels. I think most of this scheme has been exhausted. It's important to do some amount of rebalancing and bringing it back to that X% of your strategic asset allocation. Then the another important aspect I would like to highlight here. People might do it during market is rising. People don't do the same thing when markets are falling. It is equally important when markets have fallen from, I think, 12,000 levels, 12,000 or 14,000 to 8,000. So your allocation would have gone down. That time also you need to bring it back to your strategic asset allocation. And similarly, when markets rise from about 12,000 to 14 or 14 to 16,000, also is equally important to bring it back to your strategic asset allocation from whatever actually in excess to your strategic asset allocation or target allocation that needs to be pruned and brought it back to your target allocation. That has to be done quite actively. But how frequently you should do it? For example, if a market went up from about 12,000 to 14,000, 14,000, 15,000, 16,000, and tomorrow 17,000 could also be a reality down the line. Timeline, I think you and me could argue on timelines, but that could be a possibility. 17,000 or 18,000. But what level? I think this pruning, this actually realignment of the portfolio or rebalancing of the portfolio is to be done. So one has to actually take the investment advice, say, I think what is the appropriate, how the forces are, in market forces are at that point of time, how the optimism is, how the liquidity factors actually playing out at that point of time. So at an appropriate time,
okay. Rajesh, what is then the most efficient way of, if you have to rebalance your portfolio? It would obviously either involve adding more debt, picking up more gold, both of which are available at relatively attractive prices, or then trimming equity exposure. Now, you could trim equity exposure either, because your goals are coming closer to. That could be another reason, which is why it's important that you take some money off the table, and might as well. So, right, since the market is as well up. What's the most efficient way from a tax perspective as well to start reducing exposure to equity?
Yeah. So from your question, just I gather actually I'm getting two questions. One is efficiency,
yes,
doing it efficiently, and where it needs to go. There are two things to be addressed. One is the particular, as you rightly said, I think gold has given a good correction. So effectively, your target allocation would have gone down. For example, if 5% is your target allocation in gold, you would have gone down to 4% or 4.2%. Whereas equity, if your target allocation is about 50%, it would have gone up to 55% or 60%. Depends on, I think, kind of the time you have spent in the equity market. So that needs to be pruned and done some amount of reallocation to a particular asset class which went down, like gold. And similarly, balance can be kept in fixed income or in cash. Fortunately and luckily, we being Indians, we do earn something on cash. Outside India, people don't earn anything on cash. We earn at least 3.5%, 4% kind of return we earn in cash. So reallocation towards cash. So basically, you are preserving whatever gains you have made. You are preserving those gains. That's also equally important. So that is one is a reallocation to asset classes which have not performed, or I think some amount of preservation through deploying in cash. That is the approach. But what is the efficient way of doing? So within your equity portfolio, within equity funds, there are certain funds which have spent more than a year. So effectively, they become a long-term asset class, and effectively their exit loads would also got expired. So those are the actually funds one need to focus or target to start with. If those funds got exhausted, then actually you need to look at funds which are not performing, but still I think short term and still in exit low, but they're not performing. Those are the actually funds needs to be targeted. That's how I think some amount of tax efficiency and cost efficiency could also be brought in.
How do you judge a fund performance? Sometimes, it can be a little tricky. What would be your starting point if you had to pick out which are the mutual funds that are not performing well and, it should be high on your priority of exit?
Yeah, so that is quite important aspect as part of your fund selection, as well, I think, to some amount of doing portfolio corrections. There are people tend to look at it in different ways. We don't look at performance of funds very short term. We look at medium to longer term, 3 months onwards. We look at it up to 5 years, 7 years, how actually a particular fund has performed. That is one part of it. And in general, we don't look at a fund's performance based on a point-to-point basis. We focus on the rolling basis, how a particular fund has performed. And how a particular fund has performed vis-a-vis its median of the fund category, not just I think benchmark. And in bad times, how actually a particular fund has performed in terms of I think how much it has lost during worst times, and vis-a-vis how much it has actually gained during optimistic times. These two are quite important. That's what actually we call it as up capture, down capture ratios in statistical. And the standard deviation of the portfolio is also an equally important. These are all actually historical parameters. Yeah? So apart from these historical parameters, and the construct of the portfolio actually gives you some amount of guidance with respect to how a fund is likely to perform in the times to come. Means the kind of risk actually risks have been actually budgeted within the portfolio in terms of the large cap, mid cap, small cap allocations and cyclical allocations versus interest versus actually growth allocations. Similarly, interest rate sensitive allocations versus defensive allocations. How these allocations have been built and budgeted in the portfolio. All these aspects will tell you, I think, some amount of futuristic outlook of the portfolio. So combination of both historical, how manager has delivered and how manager has performed historically, and how actually he has positioned the portfolio futuristically. In combination of these factors, one needs to actually make an assessment how this particular fund can actually perform in the times to come. And accordingly, he needs to make some amount of realignment in the portfolio.
Okay, well, there you have it. That's just a gist of how to go about with your mutual fund strategy. Considering the fact that the equity markets are rallying and how we've seen them hit lifetime highs. So it's definitely very interesting times, and yeah, that's essentially how Rajesh recommends you go about your equity mutual fund investments. Okay, well, let's take on board some questions and queries then. Remember, folks, you can connect with us on our email address, themoneyshow@etnow.tv. Our first question is from Ganesh Prasad. Ganesh says, with low returns from liquid funds, what debt funds should one invest in lump sum to set up an STP to risky equity funds? Okay, so basically a systematic transfer plan that moves from debt to equity. And yeah, he's right. Debt funds have not really given much return. Even liquid funds have been negative. Even the other ones, the short duration funds, have just been 1-2% odd. So yeah, what's the best debt fund according to you with which you can start off with an STP?
Yeah, within debt, the STP, the very purpose of having an STP is to actually stagger the entry into the market. Is not to generate, I think, some kind of actually return from that particular corpus. Yeah, basically, I think you wanted to your entry into the market, you wanted to stagger in a disciplined manner, 3 months or 6 months or 12 months. So, but having said that, as you rightly put across, the liquid funds returns have come down significantly over a period of time. One could look at ultra short term as a category, to actually use it for this STP mechanism, so that I think they could optimize some amount of returns about at least 100 basis points, 100 to 120 basis points higher over liquid funds during that period of time. But if someone wants to actually minimize the risk, I think if they want to avoid any price risk or price risk within bonds in bond funds and bond category, the best way to look at it is overnight funds. But overnight funds will not give so much of return, but they bring in some amount of stability in, they will preserve the capital. So you might not expect any price erosion or mark-to-market price erosions there in overnight funds. If someone is looking to generate some, optimize some returns over liquid fund, ultra short-term fund is a better set of funds.
Well, I think with that, we are out of time too. That's all the questions and queries we'll be able to answer. Remember, folks, if you'd like to connect with us, you can write into us on our email address, themoneyshow@etnow.tv. And Rajesh, thank you so much as well for joining us today on The Money Show and helping our viewers out with gold and, of course, with the whole equity market scenario. While gold is going down, we have equity markets going high. So now is a good time to, just review your portfolio, rebalance it. Thank you for giving that guidance.
Thank you. Thank you.